Now let's go ahead and calculate GDP using the income approach. So here we're going to be focused a little bit more on income variables rather than the expenditure variables that we saw under the expenditure approach. So remember, two different ways to calculate GDP, but we should still get the same exact calculation. So what are the variables that we're going to be taking a look at under the income approach? They take a look at this. Number one, compensation of employees. So this is the biggest component of the income approach, this main variable right here. This is when you go ahead and work for a particular firm or corporation, they're going to give you some type of wage. So wages, salaries, this is all going to come under this particular variable. Proprietor's income, this is if you are a small business, if you have some type of sole proprietorship, if you have a partnership, you're going to have some type of incomes with that. There is another way to form up your own business with a corporation. So corporate profits also are going to fall under the income approach. Rental income, so if you have your own place and you rent it out, say Airbnb it, or if you just rent it out for a few days or so, you're going to generate some type of rental income. Net interest, this is if you hold onto some type of financial assets. So if you hold on to bonds, stocks, you may get some type of coupon payments or get some type of dividends. You're going to get interest from that. That is calculated under the income approach. Taxes on production and imports, nothing too in-depth with that one. And then just a few adjustments to national income, just talking a little bit about the differences between the domestic and sort of foreign incomes, foreign citizens' incomes in this type of thing. So when we add all of these things together, this is going to give us a component of GDP using the income approach. And the reason why we don't spend too much time on the income approach is because it is not used as widely as the expenditure approach. So this is why we went through it fairly quickly. But having a basic understanding of what variables are going to fall along the lines is good enough for this particular point in time. So when we add up all the variables that we see right here, we still haven't gotten GDP just as of yet. There's a special name that we give to all these variables when we sum all of them up. And that special name is known as national income. So national income is essentially everything that we just took a look at on that previous slide right there. So wages, salaries, benefits, profits for sole proprietorship, partnerships, corporations, rental income, net interest. And when we add all these up in order to get national income is only about 80 to 85% of the entire amount of GDP. So where exactly does the rest come from? So here, take a look at the balance sheet once again. Very important table for us to take a look at under the income approach. So here, the big variables are going to be bolded right here. We talked about them. So compensation to employees, proprietor's income, corporate profits, rental income, net interest, and so on. When we add all these up, we get national income right here. So national income, about $17.8 trillion, about 85% of our GDP using the income approach. So where's the additional $3 trillion come from? Where's the other 15%? That's where we talk a little bit about these three variables right here. So consumption of fixed capital, net income payments to the rest of the world, and the statistical discrepancy. The biggest one out of all of these is going to be this consumption of fixed capital. And this is just a really fancy word for us to say depreciation or the capital consumption allowance. So what exactly is depreciation? So let me give you this example. Suppose you go to a dealership and you go ahead and buy a brand new car. The moment that you buy that brand new car and drive it off the lot, what happens to the value of that car? The value of that car is essentially going to be cut in half. And that's the idea behind depreciation. You purchase a particular item, but over the course of time, that value of that good is going to go down. So here, when we produce goods and services for a particular year, we have a value at the beginning of the year, but we use up a lot of that capital over the course of the year, so that value does go down. So in order for us to get a better idea of what this piece of physical capital or piece of technology is worth for us, we do need to add in this depreciation right here. So this is the biggest component according to the adjustments to national income. And then when we add in this depreciation right here, we're going to sort of subtract or add out the statistical discrepancy and the net income payments to the rest of the world. These two components are very, very negligible compared to all the other parts right here. So it really doesn't really matter if it's positive or negative numbers right here. What matters is that once we add in this depreciation, we should get the same amount for our gross domestic product. So this $20.8 trillion, this is the same exact value that we saw under the expenditure approach. So once again, either using the income approach or the expenditure approach, we are always going to get the same idea or the same calculation for GDP. The main idea that I want you guys to take away from this is that you should be able to identify what variables go under the income approach and what variables go under the expenditure approach, and use the appropriate sort of method in order to calculate out GDP. I can go ahead and combine the income variables, the expenditure variables, all into one particular table, and I'll say use the income approach to calculate GDP, or use the expenditure approach to calculate out GDP. So it's going to be up to you to decide which is the best approach to use according to what the problem asks you, and to choose the appropriate variables. One final thing that we can talk about according to GDP based on the calculations that we have right here is, once again, focusing in on this depreciation. So there's going to be a few differences, and you're going to see this in your accounting class, between gross numbers and net numbers. So gross domestic product is exactly that. It's gross of depreciation. It actually has depreciation added in. But what happens if we want to see what happens when we subtract depreciation, or this consumption of fixed capital, out? Then we get another term known as net domestic product. So GDP minus depreciation, or the capital consumption allowance, is going to give us our idea of net domestic product. It's the output an economy produces after adjusting for capital used up in the process. So here, when we take this $20.8 trillion, subtract out this $3.3 trillion, we'll get exactly the net domestic product. So here, there are differences between gross and net. Net means that we're taking out some type of difference. In this case, we are subtracting out depreciation. So it's like when you see your paycheck, when you see your gross pay, you're very, very happy. But when you see your net pay, you're very, very sad, because the net pay takes away all your taxes, everything that you have to pay for in benefits. So that's the sort of idea we're getting at in this difference. So once again, take a look at the expenditure approach, the income approach. Be sure to differentiate the variables seen in each of these particular methodologies. And once again, there are going to be differences between gross domestic product, which has depreciation added in, and net domestic product, which subtracts out the depreciation. We'll go ahead and take a look at your own personal income in the next section.